welcome to the second episode of my How I Trade ICTs concept series. Without further ado, let's get started. We're going to cover the basics, and then if we have time, I'll probably get into the market efficiency paradigm and anything. I'll try to go into all the other stuff too, because after about the next one, maybe 2 videos, maybe 3 videos or 3 topics, then it starts to get into the interesting stuff and will be the bulk of what I'll be talking about. And it's really the bulk of what you're going to need to learn in order to read price the way that I do, the way ICT does. Well, maybe not as great as ICT does, but his students at least. But moving forward, we're going to cover the basics, and in the basics here we have bullish versus bearish, going long versus going short, the anatomy of a candlestick, and just reading a chart. What does bullish and bearish mean? When people are talking about trading and they're thinking of something being bullish or bearish, they're basically just talking about where they think the price is going or what price is currently doing. Let me take all this stuff off. Let me just remove the drawings as well. All right. So if we're looking at this chart and we're focusing just on this little piece of price action here, this right here is an example of bullish price. It's going up. And then this little section here of price is bearish price action. Same thing with this. That's bearish right here. If you look at anything related to the stock market, it's a pretty common thing. They always use the symbol of the bull and the bear. Nothing really complicated there. It's just if the price is going up, or if people have an anticipation of price moving up or the stock market moving up, bonds, equities, anything like that, futures, if they think that it's going up, they're going to consider it bullish. Likewise, if they're thinking it's going to be bearish, they're going to call it bearish. That is all you need to know regarding bullish versus bearish. Now, going long versus going short. If people are going long on whatever they're trading, whether it be equities, options, futures, bonds, commodities, right? There's also like gold, silver, oil, anything that you could possibly invest in or buy or sell in the stock market. Whenever they're talking about going long, they're basically just talking about buying it, right? They're buying it at a low price to sell it at a higher price for profit. If they're shorting it, then that means that they're selling it at a higher price and then buying it back at a lower price. And essentially what they're doing up at the top is they're borrowing it against whatever broker that they're using. For example, if you're going to sell a share of Apple, you're basically, buying it. Where is my? So let's say you're buying it here at a high of 228, right? So you borrow to sell at 228. So you borrow it and you sell it at 228, excuse me, and then you, for example, sell it down or buy it back at, let's just say, 227, right? So you borrow against your broker to sell Apple at 228, and then you buy it back at 227. You essentially just made $1. So, I mean, well, it wouldn't be exactly $1 because of commissions and borrowing fees, all that stuff. But in the general sense, in a very basic understanding, that's essentially how shorting works. You just borrow to sell it at a certain price higher, and then you buy it back at a lower price, preferably so that you can make money on the difference. It's almost like a dealership. If a dealership were to sell you a brand new vehicle at, let's say, $10,000, and then you buy it off of them for $10,000, you use it, drive it around, own it for a few years, and it depreciates in value. So you want to, let's say, get a newer vehicle, or you want to just get rid of it. you can go back to that same dealership and you can sell it back to them, or they'll buy it back from you. But because of the depreciation and you driving up the mileage on it and all that, it's going to be cheaper than when you bought it from them. So they're going to buy it back from you, let's say at $5,000, because of all the mileage, depreciation, all that. They essentially made $5,000 off of you because they sold it to you for $10,000, right, when it was the highest. And then they're buying it back from you at $5,000 when it's now, worth a lot less. That's essentially how people that short the market or short financial instruments make money. They basically borrow it, or if they have it under their own possession, they can sell it at a higher price and then buy it back at a lower price. And then going long or buying it at a lower price and selling it at a higher price is more or less the more common way of investing in the stock market that people understand, which is why they're kind of confused about, how do you sell something that you don't have, right? So you kind of just have to borrow it from your broker, and they charge you interest or borrowing fees, commissions, all that stuff. Moving on to the anatomy of a candlestick. This is the most bare bones basic framework that you're going to need to learn moving forward in this course, or even just reading a chart. Now, what is the anatomy of a candlestick? Now, a lot of you have probably seen what a chart looks like, right? These are all candlesticks, and they're called candlesticks because it essentially looks like a basic candle. There's different versions, or I should say different time, not really clusters, but there's candlesticks that are for every specific portion of time. So for example, this is the chart of Apple. This is a 5-minute chart. If you go down to a 1, there's one candlestick for every 1 minute's worth of price action. 5-minute, every one of these is 5 minutes worth of price action, and then, so on and so forth. This is a 15-minute candlestick chart on Apple. This is a 30-minute, a 90-minute, and then we start getting into like the higher time frames, so like hourly, 4-hour, daily, weekly. So this is a weekly chart of Apple. And then we have monthly, and then you can go like a lot more. You could do a lot more in there, but I really only focus on just a select few, which we're going to go into here in the next few episodes. But that's all you need to know. This is what a candlestick is. And depending on how it forms or how it looks, will give you information as to whether price is consolidating, or if it's going higher, or if it's going lower, like in the red. And these long lines or short lines above the candlestick body is also indicative of price action, which again, we're going to go into here in a little bit. This is what a bullish candlestick and a bearish candlestick looks like. If you look at this illustration here, we have these long wicks or lines on the bottom. They're also called shadows. People call them tails, but for the sake of this course, I'm going to refer to the body as the body and then the lines as the wicks. But just understand that people do call the wicks or the lines shadows or tails. They're essentially the same thing. But with a green candle, the opening price is the bottom of the candlestick body. The closing price is the top of the candlestick body, and then obviously you have the lower wick and the upper wick. And then it's reversed with a bearish candlestick. With a bearish candlestick, the opening price is the top of the candlestick body, and the closing price is the bottom of the candlestick body, with the upper wick and lower wick basically staying the same. That doesn't change, but the opening and closing of a green versus red is flipped. The wicks stay the same. Now, what does this mean for you as someone that's wanting to learn how to read price? The opening price of a candlestick is essentially where that new candlestick starts with. Might be easier if I just go to replay. So each candlestick here that's showing is 1 minute's worth of price action. Now, I'm on replay, which isn't really a good illustration of how price actually moves because it doesn't show you the movement of the candle as price is printing or as time is going forward. This right here is a much better example of how price actually looks when you're looking at it live. This is a video from one of my live streams, and I'm basically just flipping through the different time frames to essentially see what price is doing and get a better understanding. And as you can see there, how price is just moving up and down in that particular candlestick's time frame. So this is I think this is a 1 hour. So I'm just marking off my PD arrays, which we're gonna dig into in future videos. But this is essentially how price looks when you're watching it live. And just like I said, based on how it moves, it'll give you information as to what price is doing. So comparing how the live price action looks as opposed to what's happening now, it doesn't look all that accurate. I don't recommend looking at replay when you're trying to learn how to read price. It's much better if you tape read it live when price is actually printing when the market is open. Let's just say each one of these candlesticks is a 1 minute candlestick. So this candlestick is going to open down here. It's going to trade to the lowest point. It's going to trade to the highest point. It might bounce around in the middle, but essentially it's going to close up here. And that's what makes the candlestick green. So let's say, it's 11:56 right now. So 11:56, the whole minute of 11:56, it does this. So it opens here, goes lower, goes higher, maybe bounces around. And then at the end of 11:56, it stops here at the top. This is what that candlestick is going to look like. And then 11:57 is going to start, and it's going to open here, essentially where the last candlestick closed. Because 11:56 did all of this, closed up here. The next minute candlestick at 11:57 is going to open where this one closed, and then it's going to do its own thing within its own 1 minute time frame. So it's going to open, trade to the highest point up here, trade to the lowest point here, and then it's going to close down here, and that's what makes it red. So if the closing price is lower than the opening price, it's going to be red. If the closing price is higher than the opening price, then it's going to close green. And that's what makes that candlestick either bullish or bearish. The wicks just tell you what the lowest point or the highest point is that candlestick traded within that candlestick's time frame, whether it be 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, monthly, so on and so forth. That's all you need to know. Now, you might be asking, why is it important to know how a candlestick looks like or how it forms? It's because the candlestick will tell you what price is doing, like I said previously. Now, depending on how it looks, will tell you whether it's really bullish or really bearish. Candlestick opened here, traded to a low here, traded to a high here, and then closed up here. This is more or less the neutral candlesticks, right? The body kind of just closed in the middle of the wicks. But when you start getting into the point where the wicks are more one-sided, or the wick on one side is longer than the other, that starts to tell you that price is bearish, right? Or it's getting weaker. Because now this price opened down here, traded up, came right back down, didn't even give a wick on the bottom. So this tells you that within this time frame, let's just say it's a 1 minute. So within this 1 minute time frame, price opened up here, went as high up here, and then came right back down and closed above where we opened. So this right here is telling you that price opened here, tried to go higher, and then eventually rejected in this upward area and then came back down and closed here. That compared to, this one is bearish, right? Or it's a little weaker compared to these candles here because price tried to go up and then it came right back down. Same thing here, except the body is a lot smaller than this one. So it opened up, went real high, and then came right back down. So again, it's rejecting price over here. On the other side of the spectrum, of bullish candlesticks, right? We have a candlestick here with no wick on the top or bottom. So that essentially means that the price opened up, went straight up, kept going, and then it closed right at that point. So it had no high wick or had no low wick. It essentially just opened up at that 1 minute, and for 59 seconds, it went higher, and then it closed at that point. No wicks on the top or bottom. Looking at this candlestick compared to this candlestick, this one is obviously the strongest or the most bullish candlestick, right? Because it just opened, went high, closed. Didn't falter at the bottom, didn't falter at the top, just went straight up. And then likewise with this one, right? Opened, went down, kind of rejected a little bit and came right back up. It looks like it opened up, price went down, didn't like it, came all the way up and then closed. No wick at the top. On this scale, you can see on the bottom, we have the strongest candlesticks here and then the weakest candlesticks here. If we focus on the red, it's the exact same thing, but flipped. We have weak bearish candlesticks here, and then we have strong bearish candlesticks here. It's just in reverse now because it's a red candle. So the opening price was up here, closing price is down here. And it's the same understanding. Price opened up, went straight down for that full 59 seconds, and then it closed. No wicks on the top, no wicks on the bottom. And then likewise over here, price here opened up, went down, and then it came right back up. So it didn't like whatever was going on down here. Price tried to go down lower, but then it shot right back up. So it created this really long wick. So this is the weakest bearish candlestick. This is the strongest bearish candlestick. If you're looking at a candlestick chart on anything, whether it be Apple, the NASDAQ futures, bonds, oil, commodities, they all have candlestick charts. Now, they have other charts as well. They have like lines. They have area. There's all kinds of different charts that you can look at that you can use to read price. But for the sake of this series that I'm making and for the things that I'm going to teach you moving forward, we're going to be focusing on candles. Now that you know the anatomy of a candlestick, you can basically read what all these specific candlesticks are doing. Just looking at this specific portion of price here, we have a red candle. So bearish, bearish, bullish, bearish, bullish, bullish, bearish, bearish, bullish, bullish candlestick. Price on this candlestick, we opened up, went all the way down to this candlestick's low, then we shot right back up. This next candlestick opened up after this one closed, went all the way down, came right back up, and that's essentially where it closed there. This next candlestick opened up down here, traded down just a little bit, and then shot all the way up. And then we closed right here. And then the high was right here. Next candlestick, tried to go higher, closed lower, right? And then this next candle opened up, no wick on the bottom, went all the way up. And, you know, the bigger the body, the stronger the candlestick is, right? So, for example, this right here is a reversal, or it's a swing low. So this candlestick opened here, went all the way down, closed lower. This is a really, really large candlestick. And then we had a bullish candlestick that had a long wick on the bottom, right? And then we closed higher. And then this next candle opened up, traded down just a little bit, and then it shot all the way up. So this right here is a perfect example of two different candlesticks telling you two different things. So this one is bearish, bearish with a long body. So it's telling you that price was in a hurry to get down. And then we have a long wick on the bottom here showing us, well, on these two candles, there's long wicks. So it's telling you that price is rejecting this area in here. And then the very next candle opens up, comes down just a little bit, and then it shoots right back up. So very bearish into rejection, or, you know, long wicks telling you that price doesn't want to go down lower. It's kind of just, you know, oh, we're going to dip in there, but then we're going to come right back up. And then the next candle shoots up. And then same thing here. Bullish price action heading up, and then we start to see long wicks, right? So long wicks, long wicks, long wicks, and then right into two bearish candles. Now that you know how a candlestick works, you can kind of understand what price is telling you as, you know, price is printing. And like I said, there's different time frames for these candlesticks. So if you look at a 4-hour chart, every candlestick here is 4 hours worth of price action. This is going to be explained in the next few videos where I talk about top-down analysis, because the higher time frame candlesticks hold more weight than the lower candlesticks. A 4-hour candlestick is a lot stronger than a 1-hour candlestick. A 1-hour candlestick is a lot stronger than a 30-minute candlestick. A 30-minute is a lot stronger than a 15-minute, so on and so forth, all the way down into the 30-second, 15-second. The bottom point here says how to read a chart, but I essentially just bundled that in here just a little bit ago. That is it for this video. I will see you all in the next one. Bye, everyone.